Okay, so can you guys see my slides?
I can see the slides.
Okay, great. So welcome everybody, and I'd like to say welcome to Malu as well. Malu, my colleague. And hope you well this morning. I am Ms. Abu Baker, and Mr. Langwane and I will be lecturing you this morning. Today we are going to touch on a few principles in TAT letter 102. So please post any questions in the Q&A box, and my colleague and I will respond as best we can. Furthermore, any presentation slides we will then upload after the session. All right. So what we'll be covering today is the IFRS 3 amendment, the change to the definition of a business. So this I will be running through very quickly, as there are some detailed material on the site. So we won't be spending too much time on that. Then I'll be looking at measurement principles to use for an associate in terms of IAS 28, and cover some areas where confusion may arise with regards to differences between associate and subsidiary in terms of its accounting. And then we will look at intercompany transactions with an associate. Then aspects of control will be discussed, covering considerations in terms of IFRS 10, some intercompany transactions for an entity for which we have control over. Okay, so looking at the definition, the amendment of a business combination definition. Okay, just as a side note, I would like to mention that the study material and the tutorial letters are there for you to study from. However, using them whilst writing your test and exam is considered cheating and may amount to plagiarism. So just bear that in mind, okay? So the material is there for you to learn the concepts, etc. It is better for you long term to learn to use your IFRS textbooks as a reference. So in terms of the IFRS 3 amendment to the definition of a business, I expect that you've already gone through the material in your TAT letter 102. And this is basically, it's also mentioned in your TAT 102 where these 4 videos, they are quite important because, you know, this is a new it's an amendment, and these videos cover this aspect in quite a bit of detail. The definition is in your IFRS textbook, but just knowing the definition of or what it says doesn't really mean anything if you don't know how to apply it. Okay, so we would also like feedback from you guys, you know, when you use these videos and all of these other material of, you know, whether it helps you and, you know, what of it helps you, etc. And your input would make a difference for us to assist you further. Okay. So once you've looked at these videos and looked at the practice questions in the TAT letter, you would have a pretty good idea of how to deal with a similar question, okay? So this diagram, look at the diagram in your TAT letter. It is quite small here, but these are basically a summary of what are stated in the paragraphs of IFRS 3 that describe the definition and its change. Okay, so it describes the concentration test, how to use it, and then how to further assess where you don't meet the concentration test or you decide as an entity not to use it. Okay. So by using this process, we're basically trying to establish if the group of assets purchased should be accounted for as a business for which we apply IFRS 3 measurement criteria, or is it merely a group of assets and should be individually accounted for in terms of the relevant asset standards. Okay. What would also assist you in determining further assessment? Okay, we'll come to it. I'm just going to highlight a few aspects regarding that. And I just want to do a small example as a reminder of how the concentration test works. Okay, the rest of this diagram, once you analyze it, you will get to know how to do the further assessment. But it's not difficult. If you work through the questions in your TAT letter, the examples, you will get the hang of it. And also make sure you use your IFRS textbook when you're doing this. Okay, so let's look at a short example. Seeking Limited. So Seeking Limited purchases a company called Cells Pty Limited. Okay, Cells Pty Limited have an in-house research and development project that is in the final phase of developing a treatment for one form of gum cancer. So during development of this treatment, historical data and trials are used, prescription criteria and chemistry designs and procedures predicted to be required to complete the final phase is utilized. So that's quite a bit. So let's break it down. Okay, so what we need to complete this project is the historical data, the criteria for the formula to use, the chemistry design, and other necessary procedures. Okay. Furthermore, there are no employees, other assets, and other processes or other activities are transferred. Okay, so Seeking Limited now, let's say he chooses to apply the concentration test in terms of paragraph B7b. In that instance, we need to consider, can all these elements be combined to form one asset? So all these elements would be capitalized as part of an internally generated intangible asset, and this would be considered as a single identifiable asset. So in the concentration test, we want to establish if these elements form one single asset, or do they even form a group of similar assets? Okay, so in this instance, it's one single asset, right? Note that there's no employees, other assets or processes or activities are acquired, so the further assessment is now not needed. Okay, so therefore no other assets need to be considered, so the acquisition is not a business. And we will then use IAS 38 to measure the asset, and we will not then use IFRS 3. So this is just a short recap of that. There's important things to note when you're doing these questions, is that say we now decide not to use the concentration test, right? Or we have more than just the intangible asset as part of the entity purchase. So there are other assets and they do not form one group of assets that are similar. We basically then fail the concentration test. Or if there are two groups of assets and the fair value of each of the groups, either of the groups are not dominant, so it's not majority of the fair value, then we fail the concentration test because then all of the fair value is not concentrated in one asset. In that instance, we need to further assess. Okay, we would also use this further assessment if we decided not to use the concentration test. So the paragraphs that would then apply are paragraphs B8 to B12. But of these paragraphs, what would guide you further is to determine if to determine if the assets have outputs at acquisition date. So the thing is, to be classified as a business, you do not necessarily, according to the standard, you do not necessarily need outputs to be classified as a business. It's more the input and the process that attributes it to be a business. So these are then assessed in these paragraphs. So this will direct you whether there's outputs. There are paragraphs to use for that. And if there are no outputs at acquisition as yet, then there are different paragraphs to use as an assessment. All of these are summarized in that diagram. And the examples in your IFRS are very important. In IE 74, there's examples A to I. Okay, and the video explains these examples very well. So now I'm going to move on to explaining the associates because there's a lot of principles that need to be filtered through and clearly explained. So let's move on. We have an entity, Milo Limited, right? And Milo Limited is now the associate. So Pops Limited acquired 25% interest in Milo Limited on 1 Jan 2019 and exercises significant influence over Milo Limited. So because it's more than 20% and we have significant influence, we know it's an associate. And we would then apply equity accounting. Okay. Because it's just significant influence, it's not control. Okay, so you need to bear that in mind. The purchase price was paid with different elements, a 1 million rand cash. Then we have an asset transferred. Okay, the asset transferred of a depreciable asset with a carrying amount and a fair value. So we need to establish which should we use, bearing in mind that this is an associate. Then we come to there's an amount to be paid in 4 years' time. We refer to this as a deferred consideration of 500,000 rand. So in future, in 4 years' time, you will pay the 500,000 rand. And then you have transaction costs. And here it's your advocate fees of 100,000 rand. So when we're calculating the consideration paid, I just want to discuss the asset transferred first, because this creates a lot of confusion. So if a subsidiary is controlled, so that means it is not an associate, right? So there is a difference here to how we treat an asset that is transferred in lieu of a consideration. So basically, if we transfer this asset in lieu of payment for the purchase of a controlling interest, then it is important to establish whom it is being transferred to, right? Is it transferred to the shareholders or into the company name? So if Milo Limited was a subsidiary, if we consider it a subsidiary and the asset was transferred as payment and used in the business, would the asset not still be part of the group and used within the group, because Pops Limited would then have control over Milo? Okay, so in that case, we can leave the asset at its carrying amount and account for it as such in the consideration paid. So in the consideration paid, we will take the carrying amount of this asset if we took this company as a subsidiary. Okay, and if the asset was used in the group, transferred in the entity's name. Because remember, on consolidation, we now combine a subsidiary, we consolidate a subsidiary and the parent as one entity. Okay, so we cannot be considered to be selling to ourselves. So in that case, we then assume the carrying amount. However, if it was transferred into a shareholder's name in his own capacity, then it's not going into the company's name and it's not going into the group. So we will then account for it at its fair value, because then it's treated as a normal exchange. Okay. Now, for an associate, does it make a difference? Okay, an associate is not controlled by POPs Limited. So Milo Limited is not controlled by POPs Limited, but merely has significant influence. Therefore, POPs Limited share in a percentage of equity of the associate, but does not control it. So it will not be considered one entity when consolidated, right? Therefore, the asset given in lieu of the interest in shares, so the asset transferred as part of the consideration paid, is seen as an ordinary transaction taken, and the asset is then included in the consideration paid at its fair value. So in this example, the fair value is 300,000. Okay. The next aspect in the consideration paid, this one doesn't really create that much confusion, although exam technique related to this sometimes is not very good, so I chose to discuss this. Right, so the next element of the consideration paid is the deferred consideration, which just means an amount to be paid at a future date. So we need to account for the effects of time value of money so that we can get the fair value, right? So in order to correctly reflect the item at its fair value, the present value calculated represents its fair value. We usually find the discount rate in the additional information. So in this example, we would use 5% per annum. So per annum is also something you should note. Does it say per annum? Does it say per month? Okay, good exam technique to score marks is to write down what you punch on your calculator. So when you get a so you will then write down your N, which is 3 years, your I, 5%, the future value that you require to pay in 3 years' time is 500,000, and you then compute your PV, which amounts to 431,919. Okay, so we follow the same principle for a subsidiary. So in this instance, for a subsidiary, this doesn't change, right? We still do this PV calc to arrive at your fair value, okay? So, and then cash stays at its 1 million rand. Now let's look at the transaction costs, okay? This is one more aspect is indicated for the consideration, and that is the advocacy fees. So this confuses most students, so I'd like to just run through it quickly. In IFRS 3, paragraph 53 stipulates that all acquisition-related costs must be expensed, but there is an exception. Okay, so now IFRS 3 applies to the subsidiary. Okay, and for this rule, you would expense all acquisition-related costs, but there is one exception, is if you issue debt or equity, then the cost related to that must be deducted from equity. Okay, but what do we mean by this? Okay, so deduct from equity, what do we mean? So for instance, if you issued shares in lieu of payment in terms of IFRS 3, remember we take the shares at its fair value in the consideration when consolidating, so the fair value of the consideration transferred. So these shares would be your equity, and the cost to issue them would be deducted from the fair value of those shares in terms of IAS 32 and paragraph and IFRS 9, which deals with the financial instruments. So the same is then done in the separate books. So this is so for a subsidiary in its separate books as well as its consolidated books, right? But then this is then treated differently when calculating for an associate. Okay. Because an associate is governed by IAS 28, and IAS 28 paragraph 10 includes the purchase price and other costs directly attributable to the acquisition, So you would add the purchase price, which would be your cash, and all of these additional expenses would then be added to the purchase price. These expenses could include professional fees, legal fees, transfer taxes, and other transaction costs. Okay. So I see most students here make the error of deducting it for the SOK as well. So just remember it is added to the cost, to the consideration paid for an associate. Okay. In the separate books of Milo Limited, the cost of the investment is what is recorded. Okay. So, and this would be so for the subsidiary and the associate. In terms of IAS 27, paragraph 10, we record the cost of the investment in its separate books, okay? But in the consolidated books, the investment in associates is recognized according to the equity method, which is the cost for the group and accounting for changes during the year. Okay, so IAS 28, paragraph 10 further explains that, and if you read it with the IFRS 3, where it's excluded from the scope of IFRS 3, then you would read that the cost for the group shall be allocated to the assets and liabilities on the basis of their relative fair values at the date of purchase. Such a transaction or event does not give rise to goodwill. So there is no goodwill for an associate because we would then, in the group, assume the assets and liabilities of the associate as one line item, only one line item, but at its fair value. Okay, so if there's no goodwill, there can still be a gain on bargain purchase, is what we know it is in your subsidiary. But in an associate, we refer to it as an excess. So where the consideration paid is less than the percentage share of net asset value of the associate, we then recognize an excess in the associate. Okay, again, the cost of the group is the asset and liability at fair value on the purchase date, on date of purchase for the group. Okay. So let's look at this calculation. In the example, the equity of Milo Limited on 1 Jan, that's supposed to be 1 June, but it's fine. It's supposed to be 1 June 2020, sorry about that. So that was the acquisition date was 1 June 2020. It consists of the share capital, retained earnings, your equipment, and your debtors. But what we have here is then two assets, right? The equipment and the debtors are each carried at their fair value, at the carrying amount, and we now need to bring it to its fair value, right? Because the cost for the group would be then at fair value. So we take it at the difference between the 2 million and the 1.3 million. And that's what we account for in our net assets. Remember, the share capital and the retained earnings makes up your equity of everything that's already held in the company. That includes their carrying amounts. Okay, so where your fair value differs, that's where we need to bring then your equity in line to get your net asset value correct. Okay, so in this instance, our total for our net asset value works out to 11 million. We then have to multiply to the 25% because it's an associate to get our 2,750,000. Okay. Remember when we did our consideration paid calculation, we said we will include the 1 million as is. Then your asset was included at fair value of the 300,000. Then we derived the fair value through the PB calc for the deferred consideration at 431,919, and we add back our advocacy fees of 100,000 based on IAS 28 paragraph 10. So we end up with a consideration paid of 1,831,919, and that gives us an excess That gives us an excess because your net asset value is more than what was paid. Okay, so as we said in the previous slide, we don't have goodwill, right? So we would have just, if it was the other way around and your consideration paid was greater than your net asset value, then we would have just taken the consideration paid as your investment. Although you're required to do both calculations, both portions, the consideration paid and the net asset value, to arrive at whether it's goodwill or excess. Don't just calculate your consideration paid and put it into your journal or whatever. You may lose a lot of marks for that if it ends up to be an excess. Okay. So, but now if the net asset value is, which in this case is more than the consideration paid, we have to journalize the excess. For the goodwill, there is no journal. Okay, so how is the excess journalized? Students primarily get confused with associate and subsidiary when doing this journal. Okay, so firstly, we note the difference between a subsidiary using the acquisition method and the associate, right? So for a subsidiary, the assets and liabilities are assumed at their fair values at date of acquisition on a line-by-line basis as a subsidiary and the parent combine as one company for consolidation purposes. So as seen in this journal, we then give NCI portion and their portion, and we have goodwill or gain in bargain purchase, but we do not do this for an associate. Okay. An associate is not controlled by the parent, so we do not combine an associate and parent as one company, but rather treat it as an investment in the consolidated books using the equity method for calculation. So we debit the investment in Milo Limited as an associate in the consolidated books and account for all items net of consideration into one line item. So there's just one line item there. Okay. However, it's the credit leg that students also struggle with. Okay, so to get your credit leg correct, you need to establish the dates of the transaction on a timeline. So the excess essentially increases profit taken to P&L, but when was the associate acquired? The associate was acquired before the beginning of the current year, okay, which was 1 June 2019. Remember on my previous slide I said the date was incorrect. So we purchased this associate on 1 June 2019, and that was before the current year. So we then take the credit leg to retain earnings. Right, if the acquisition was made during the current year, we would then take the excess credit leg to P&L. All right. Now let's look at the intercompany transaction. An asset included in the PPE on 31 December 2020 of Pops Limited amounted to 2 million. And was purchased from Milo Limited on the 30th of June 2019 at a profit of 40% on cost. Right. So we purchased the associate on 1 June 2019, but then we had an intercompany transaction on the 30th of June. Right. The machinery had a useful life of 10 years on the 30th of June 2019. So let's see, how do we journalize this, right? We ask ourselves a few questions before we can confirm the correct entry. When did the intercompany transaction take place? So it took place before the current year. Okay, so if we take anything to P&L, we must remember it is transferred to retain earnings. So It is transferred to retained earnings. Okay. So in this, is this a subsidiary and associate? That's the other question we ask ourselves. We know it's an associate, right? So an associate only has 3 line items: an investment in associate SFP, share of profit from associate P&L, and share of OCI of the associate. Okay, so these are the only 3 entries you would have, 3 line items you would have for an associate. In whose books does profit lie? Right? When the associate is sold to the parent, therefore profit lies in the associate's books, which is Milo Limited. So in this case, profit lies in Milo Limited's books. So if profit lies in Milo Limited's books, which is an associate, then where does the asset lie? The asset is in the parent's books, okay? And this makes this an upstream transaction where the associate sells to the parent. So when we account for a sale, we would take the profit on sale of an asset to P&L, but the transaction occurred before the current year, so now it's sitting in retained earnings. So since this is a depreciable asset and is included in POPs Limited opening PPE, so POPs Limited is the parent and the asset is still included in the opening PPE balance, we reduce the asset amount with the unrealized profit calculated. Okay, we have to remember the correct fraction to use. Remember, it's always what we want over what we got. So because it was 40% on cost, we have our cost, so we need to establish what we want. We wanted 40%. All right, so that's therefore your fraction is 40 over 140. We have the 2 million is the selling price, which is the 140. And the 2 million is the selling price because that's the amount that the parent has in his opening inventory, opening PPE. Since that is the selling price, it's what we want over what we got. We've got the selling price. We want the unrealized profit, so we do 40 over 140. And do not forget to multiply by the 25% for the associate's share. Okay. We then have to realize the unrealized profit through depreciation since acquisition to beginning of the year, because this is a depreciable asset, and because the additional amount to the original carrying amount would have been sitting in your PPE asset, we then depreciate it too much, okay, as an individual company. So when we consolidate, when we now giving ASAC a share on consolidation, we have to reverse that amount, okay. So we realize the unrealized profits through depreciation since acquisition to beginning of the year. And we do this using the retained earnings account at the beginning of the year. Okay. And then obviously, you know, when we normally depreciate, we would debit depreciation, credit accumulate depreciation, but now we're reversing it. So we debit accumulated depreciation and the balance then goes to retained earnings. Okay. So we take this journal can be done in 2 journals, but for exam technique purposes, it's better to just do it in 1, right? Normally, we then account for depreciation by debiting depreciation and crediting accumulated depreciation, right? So remember, we don't use now the associate leg because the asset is in the parent's books. Okay. Now, what would we do? So now we want to realize the additional depreciation. But what would we do if this was then accounted for, or if the associate sold to the subsidiary and not the parent? Then what would we do, right? If you think about it, because the subsidiary and the parent are consolidated into one entity, they are now considered one entity for consolidation purposes. So if this transaction took place between the associate and he sold to the subsidiary, your journal would still be the same. Okay. But we need to account for now the current year depreciation. Okay. Now in the current year, remember where was profit? In the associates books. Okay. So when there's a P&L adjustment for the current year, that we can then use the line item that goes to P&L for an associate. Okay. So we would again, we're reversing depreciation. So we would take the SFP account where the asset lies in the parent's books. We would debit accumulated depreciation for current year depreciation. Remember now, this is just over the 10 years. We don't have to multiply by months because it's been an associate for the entire year. Okay. And we then credit your share of profit from associate because that goes to P&L. We do not use the line item called depreciation P&L because an associate only has 3 line items. Okay, so the transaction did not affect investment in associate SFP account because the asset did not lie in the associate's books. Okay, Malua, how am I doing on time?
No, we're still within time, Sajida.
Okay, great. So the transaction did not affect the investment in SFP. So what if the associate now purchased from the subsidiary? The associate purchased from the parent. Okay, so let's look at this. This would then be considered a downstream transaction where the parent sells to the subsidiary, so the profit lies in the parent's books. So as you can see now, because it was a depreciable asset, we then use the profit on sale of asset line item in the current year for P&L. Remember that would again be retained earnings because that lies in the parent's books. If it was done in the previous year, the transaction is in the current year. Then we then credit investment in associate SFP because now the asset lies in the associate's books. So now this does affect your carrying amount on the SFP associate line item. Okay, we must remember then to still do the depreciation adjustment for this. So again, it also affects your SFP because remember now we would have normally debited accumulated depreciation in your SFP account, but we didn't do that. We don't do that now because investment in associate just has those 3 line items. So we take it, so we debit investment in associate SFP, and we then credit your depreciation P&L in the parent's books. Okay. Okay, then there's just a few IFRS 3 examples that apply to the subsidiary or IFRS 3 rules, if I may say that. I've just picked these 2 because these are the items that students tend to get incorrectly, especially in terms of a discussion question. So it's important to work through your IFRS 3 Appendix B to get a better understanding of this. And there's 2 nice examples there in your appendix. And basically this slide summarizes that principle where the acquirer shall recognize separately from goodwill the identifiable intangible asset. So if you have an asset or it's not yet recognized as an intangible asset in the separate books because it's lacking a criteria, right? So the criteria in IS 38 says separability criterion and the contractual legal criterion. But in IFRS 3 it says no, it's or. Okay, so if you have either one of the two. If it meets the separability criterion or the contractual legal criterion, you may recognize it as an intangible asset at its fair value at acquisition date for when calculating your net asset value of your subsidiary at acquisition date. Okay. Then there are other aspects relating to this. The separability criterion is obviously then where you are able to sell or transfer that asset individually without any conditions. So in this case, if there's a confidentiality condition, you cannot then, for example, transfer customer list because you would not be complying with that condition, then that asset is not transferable, not separable, and then may not be recognized as an intangible. So you need to be careful and look out for those aspects. The contingent liability is another exception for your IFRS 3 net asset value calculation, where an intangible asset when a contingent liability is recognized at acquisition date, it does not have to have a present obligation if one or more of the criteria are met. Okay, so all of the criteria need not be met. As long as you can reliably measure it, you can then recognize it as a contingent liability, which would then reduce your net asset value because this is now a liability. Remember to look out for a indemnification asset where the entity would then insure you to reimburse. Like for instance, if it was a court case, then you would then be reimbursed by the entity of 70% of that fee or that liability. Then that also needs to be taken into account, and whatever tax rule applies to this would then apply to the indemnification asset. Okay, so you would set the two up against each other. And that's all for me. Thank you. I would hand over to my colleague Malu.
Thank you, Sajida, for the presentation. I just wanted to maybe draw your attention to some of the questions that are on the chat. If you can maybe just respond to those questions, I would tell you what the first question was. The first question was on deferred tax on equipment and debtors. So one student asked, why are we not taking into account the deferred tax on the equipment and debtors? And I think that relates to the IFRS 3 question that you.
Oh yes, okay. So the one where I did the depreciable intercompany, but ASOC versus sub. Okay, for this,
I think it was before that. I think it was before that. Wait, was it not when you were addressing the concentration test?
Is it the concentration test?
Yes,
so
it was.
Net asset value. In the net asset value, we would consider the deferred tax. I just chose not to put tax into this example to filter through the differences between associate and subsidiary, because that was the primary focus. But yes, you would definitely have, let me just get my slides back on, then I'll just show you. So there is a deferred tax implication there. Okay, so which one are we referring to? This one, yeah. Yes, there is a deferred tax implication in these journals. I just chose not to put it into this example to avoid confusion, but there's definitely deferred tax implications. But for the investment in associate, remember, we would take it net of tax, right? So your retained earnings account is always net of tax. And then if you're dealing with a transaction between an associate and the parent, you would need to see which leg affects the associate. So the leg that affects the associate would be combined into, so say if it was deferred tax SFP that affected the associate, it would be combined into this line item investment in associate. But if the deferred tax was in the parent's books, where the asset was in the parent's books, then it would be listed as a separate item on the journal as deferred tax SFP. I don't know if I've answered the question.
Okay, it's fine. Let's move on to the next one. It's a quick one. The student's asking the concentration test. If you can just briefly summarize what the concentration test is and where can they find it in the IFRS books?
Okay, in your IFRS, okay, so your concentration test, you will see there's a, okay, so I'll just go back to this slide. In your tutorial letter, these are the videos that I've completed, and they are on my UNISA for you to view. So they're not very long, but they are quite detailed, okay? So but just as broadly, like I indicated here, your concentration test is basically if substantially all of the fair value is concentrated into one asset or one group of assets of that entity, right? Of the entity being purchased. So say you purchase an asset, you purchase an entity that has multiple assets, right? It has land, it has buildings, it has inventory, all of those. And there's one asset in there, say for instance, land, that is that amounts to about 90% of the fair value of that entire purchase. Then you would have passed the concentration test because 90% of the fair value is then concentrated in one asset. Then that would be considered the purchase of a group of assets and not the purchase of a business. So what the concentration test does is it emphasizes the amount of that's attributed to the process involved, and also if there's more of an amount paid in lieu of the process involved, then that would be considered a business. But where the assets fair value makes up substantially all of the value that's being purchased, then that passes the concentration test and says you have not met the criteria and you will not be assessed as a business. Then you will account for those different assets like inventory, land and buildings and so forth within their respective standards, like IS 38 for intangible assets, PPE, IS 16, IS 2 for inventory. So you would then, in your books, when you purchase this group of assets, so in this case, Seeking Limited would then, in his books, just account for the purchase of an intangible asset as opposed to the purchase of a business. Okay. If you do fail the concentration test, there is a further assessment to go through, which I've also have a detailed slide on that, a detailed video on that. The video is quite detailed. It's very well explained. I just want to go back to this map. Just a second. Can you guys still see my slides, eh?
Yeah, the slides are still appearing.
Okay. I just want to go. Okay, so if you look at this diagram, right? This diagram deals with the further assessment, okay? And each one of these blocks have been tackled in that video. So I want you to please go to those videos and work on them because that will assist in your understanding. If you look at, we can go through this map quickly, all right, where do you want to apply the concentration test? Say you decide no, or you do not meet the concentration test. If you do not meet the concentration test, then you further assess. So in the further assessment, you first need to establish, if I take into account my inputs, the process, and all the items, all the assets that are put in, do these activities give me an output at acquisition date, right? Then there are different questions to ask in terms of, and there are different paragraphs that apply when you answer that question. So say there are outputs at acquisition date. So what I mean by that is, if you're buying I don't know, a cartel of vehicles, right? Then at acquisition date there is an output because you're able to sell that vehicle today. Okay, but it's not necessary to be considered a business. That's the point of further assessing it, right? So is then the process critical when applied to the inputs to continue producing outputs? So this will be in your question. You need to analyze the information and understand, is this a critical aspect to the business, like a skilled workforce? Like most businesses, some businesses are labor intensive. So without that skilled workforce, you don't have an output. Eventually, you don't have a business. So if the answer is yes, there is a skilled workforce and you cannot continue without that, then yes, it is a business. Okay, so if you further look at this, does the process significantly contribute to the ability to continue producing output and is considered unique or scarce? So it may be a resource that is very important to the business, but it's easily replaceable. Then it's not considered a business unless if you cannot replace it easily, then that aspect is considered very important to this acquisition and to this business, and therefore the acquisition is a business. So you would have to look at the information in the question. But like I was saying, the tutorial letter is detailed examples, and your illustrative examples in your IFRS book is IS illustrative example 74. That paragraph 74, under that, there are examples A, B, C, D, right up to example I that are very good examples to go through, and most of them have been tackled in those 4 videos. They've been explained in detail there. So I hope this answers your question.
Yes, Sajida, can we move to the next one? The student says, hi, can you please explain how to calculate the fair value of the gross assets in IFRS 3 B7, I think it's P7P, A to F. So
okay, again, you see, sorry, I want to just interrupt you there. So you see again, in that, in my video part 2, go to IFRS 3, the part 2 video. It has the full explanation. The reason I've highlighted these videos for you is because they've been done in detail, and we have only 2 hours for Malu and I to present now, so it's not going to. I won't be able to give you enough information to be able to assess this properly. That's why the video is done it in quite some detail. But also, in answer to your question, how do you do it numerically? So it's basically the fair value of, say, asset A is 100,000 and asset B is 100,000, and these are the only 2 assets within the group. So even though these 2 assets cannot be combined, asset A is tangible and asset B is an intangible asset, they cannot be considered similar, right? And these are also similar assets in video. My part 3 video explains what's considered similar assets and can be combined and what cannot be. Okay, So, but if there are these two groups and they both 100,000, 100,000, there is no asset there that is substantially all of the fair value, because now they are equal in fair value. So you then need to further assess, because it's failed the concentration test. The value of that company is not concentrated only in one asset. So we look for like the IFRS is not given a percentage threshold, but you would have to use your subjective judgment where you can see at least 80 or 90% of that asset, all of the fair value is just for one asset and the rest of it is for all other little assets. Then the concentration test would be met, and that cannot be a business. Does that answer your question?
Okay, we will just see if there's a follow-up from a student. Thank you. And then the last two, they relate to the question that was the example that you did. It says, I think it's the one where you had the deferred consideration. They're asking if n is equal to 4 or it's equal to 3.
Oh, I might have made a mistake. I think the question said 4. Where's the question? Sorry, guys. Yes, the question said 4. I'll just correct that. So we can just make it 3 because the calculation there is 3, but it's yeah, that's just the number of years. So here, how you would tell in a test or an exam, they would give you the number of years, right? They would give you the years. So they would say, for instance, we purchased this on 1 June 2019, but in 2022, 1 June 2022, this amount should be paid. So you must now count 1 June 2019 to 1 June 2020, 2021, 2022 would give you your 3 years. So that's how you would count it. Sorry, guys, that is an error on my side. Okay, we can move on next to the next question.
Okay, the next question is, where does the 1.3 million come from? So the student didn't specify what it relates to, but they said, where does the 1.3?
Okay, that was part of the net asset value. So I just did that for space, but basically in the question, they would tell you. So when you go through the questions in your tutorial letter, you will see, it will tell you that an equipment was given at, an equipment forms part of the net asset value at acquisition date, but the fair value of the equipment is 2 million and its carrying amount is 1.3 million. So in terms of IFRS 3, we need to assume our assets and liabilities at acquisition date at their fair value. So that's for a subsidiary. But then we have a similar instance for an associate where we're going to consider the cost for the group must be at the fair value on purchase date. So it amounts to the same thing. So yeah, again, I made an error here on top. It's 1 June. Sorry about that. But basically, this means that we have our fair value. This is our fair value. This is our carrying amount. How should we account for this equipment? All right. Some students take the entire fair value. We cannot do that. We need to take the difference because I did explain that your share capital and retained earnings comprise of your owner's equity. So your owner's equity is equals to your assets plus your liabilities. But if your assets and your liabilities are not assumed at their fair value, we need to account for that difference. So now they're sitting at their carrying amount. So for that to be correct, we then just adjust for the difference. So this calculation is one alternative which is most commonly used. The other alternative is very complicated and time consuming, but it would basically consist of you listing all of the assets at their fair values at that date and adding that up, and that should also equal your owner's equity. all right, of 11 million. So this is just a shorter and a better exam technique method of doing it. And that's why we account for the difference between carrying amount and fair value, and we then add it or subtract it where relevant to your owner's equity. Does that answer your question? In this instance, you will also have your deferred tax effect on this. I just didn't put it into this example because I was just trying to filter through the differences between sub and associate. Okay. We can move on. Malu, do you want to take a break? Are there more questions?
No, it's fine. The questions that were here were addressed. I will just maybe upload my slides and then I'll start. Thank you so much, Sajida.
Oh, thank you. We're not going to take a break now, eh? We're out of time.
Maybe we can just take a 5 minutes break. Yeah.
Okay. Okay, great. So I'm going to stop share and then you can so long share.
No problem. Thank you.
Thank you, Malo.
Sajida, maybe you can just address why, where is the question that the student that you were, the example that you were using, because the students are asking where can they find this question.
Okay, now I extracted principles from past papers, but they're not all in one question. They're in different aspects of questions where students struggled during exams and tests. So I extracted the primary principles where they struggled. But what I am going to do is I'm going to attach this slides for them after the session. Then I'm going to upload these slides on my UNISA so they can use the PDFs of it. And it's basically the questions in the TAT 102, all of them cover these aspects.
Okay, no problem. Thank you.
So I've sort of taken jibs and jabs from different questions where students struggled that I've noticed in tests. And I've put them together to, to basically illustrate what are the differences between SAP and ESSA, because these were the primary errors that students make.
Okay, thank you.
Okay, thank you.
Good day, students. I hope you can hear me. We are back for our session. Thank you so much to Ms. Abu Baker for the lovely IFRS 3 and IS 28 presentation. So as you see my name on the screen, my name is Mlungisi Hlongwane. I'm the senior lecturer responsible for FAC 4862/464, meaning both level 1 and level 2. So guys, Sajida has already covered a lot of things, and my one is question based. So we're just going to be doing a question. It's a previous test or exam from another institution, but it's going to be relevant to our 102, and we really apologize to try and give you more stuff, more than what is on your tutorial letter. But I just felt that maybe demonstrated the principles better, the principles that are covered in your 102. So what we are going to be covering in this class would be IFRS 10, which is the control. Remember, before you can now decide to say I'm doing business combination, which is IFRS 3, which is what you covered with such, you need to have met the control definition. So you must have control, therefore you can have business combination, which is IFRS 3. So that's what we're going to be covering through the example that we're going to be doing today. Sajida, I hope I'm audible and you can be able to see my screen.
Yes, I can see your screen and you are audible.
Okay, thank you so much.
Okay.
Yes, students, feel free to ask questions on the chat box. If it's general questions, Sajida will be able to respond to them. But if it's maybe specific to what I'm covering here, then she will just let me know at the end and I'll respond to your questions. So feel free to be asking those questions. So as the question comes to your mind, you type it there before you forget it so that I can come back at the end. So remember, it's in relation to what is being presented here today, and also anything that maybe relates to control or the elimination of the unrealized intragroup profits, which now relates to a sub. You can be able to ask those questions, even though it's not specific to this question. So if you're struggling with those principles, keep those questions coming. Okay, so the class example that we're going to be doing today, it's an example. The name is Protech Group Limited. Okay, so what I'm going to be trying to cover here, it's also the element of the exam technique, which we sat down and we identified both at cycle level and also at CTA level to say, when it comes to discussion question and also maybe when it relates to the journal entries, students still struggle in terms of how to approach a question, be it when they're still reading the question or also when they're attempting the question. So it's very important that you read the question carefully. And I always say with accounting and perhaps with MENIC, the devil is always in the detail. So the minute you rush through the reading of the question, that's where you lose a lot of marks or a lot of pointers. So you just have to make sure that you take your time and you read. I even said it's okay to go over your reading time, just making sure that you understood what is being presented to you as a scenario, also with the required, and we will get to the required. You are also expected to spend time and just make sure that you are able to understand. I know there are people who are quick readers and those that are slow readers. So if you're a slow reader, don't try and rush the process because you will struggle when you have to answer. Okay, so now let's start reading. Protech Limited is a South African company that is listed on the Johannesburg Stock Exchange Limited with a primary business of education and professional training. Protech is a multi-divisional entity, and its operations include a primary and a secondary education, tertiary education division, and the professional development and training division, and various other small divisions. Okay, so what we see here, it's quite a big company and it has a lot of division, but more than anything, this is just the background information, which is not really that important when it comes to accounting. Perhaps when you're looking at auditing and you're looking at MENIC, which is, you know, another thing that you need to start getting used to now, because at cycle level, the reality is that you will have to integrate. So you need to be thinking integration, and perhaps even at CTA level, that's something that you must start now getting used to say, okay, what does this tell me in terms of accounting? What does this tell me in terms of tax? What does this tell me in terms of auditing? What does this tell me in terms of management accounting? So that's the other thing that now you now need to start thinking about, especially when you're at level 2, you're a level 2 student. Okay, so then we move on to the next part. It says Protech also has various investments. So when it says they have various investments, so I'm saying to myself, I must expect more than one investment in the question because they told me that it has various investments. So it's an expectation that I create in my mind as I'm going through this. Okay, so and then it says consistent with its primary business, the current financial year end of all companies is 30 September 2013. Why is this so important? The year end. The year end is very important because you need to do everything, and everything that happens, you must relate it to year end. If it's an acquisition, when was this acquisition? When did this acquisition take place? And how many months to year end? Was it before? Is it a since period, or it happened in the current year? And then from what date until the current year, the end of the current year. So that is very important because it determines whether you have to apportion some of the amounts or not. And you need to understand, even in terms of your journal entries, that's where now you need to be thinking, is it the current year? Is it in the previous year? And also between the retained earnings and also the profit for the year, which account to use, because if something happened during the year, it means that when you are reversing the acquisition elimination entry, IFRS 3, you will not use the description that says retained earnings, because during the year you do not have the balance for retained earnings, but we will get into details in terms of that. Okay, so then we move. So I've identified that I must have more than one investment because of the various types of investment. And then number 2, I've identified my year end, which is 30 September 2013. And those that are using a timeline, which Usajita demonstrated earlier, then you start drawing your timeline. You know that the beginning of the year must have been the 1st of October 2012. And then if the year end is 30 September 2013. Okay. So then we move on to the next paragraph. It says new SA and it's in bold. Okay, so what does this tell me? This tells me is that, okay, this is the first investment in terms of the slide 3 that we just looked at. Okay, so let's see what are they saying about this Protech. Protech, about this new SA, Protech acquired 40%. Okay, so when they acquired 40%, generally that's not the majority. Because if you have 40%, then it means that there's other people with the 60%, okay, of the ordinary shares and the voting rights. Okay, so when they're talking about the voting rights, I'm starting now to think about that definition of power. And I'm thinking, are they talking about the existing rights? Are these the relevant rights that we need to consider in terms of determining whether the entity controls the other or not? Okay. And then new SA, then that new SA, we already know that that's the name of the investee. This is the company that they're investing in, okay? And then they're saying on 30th of April 2013, okay? So we said that the year began in 1st of October 2012, and then it ends on 30 September 2013. Therefore, this acquisition took place in the current year. So this is the date of acquisition. Sorry for that it went to the other side. Okay, so that's the date of acquisition, which is the 30th of April 2013. So that's where we will be assessing from, whether it's an associate, whether it's a subsidiary or just a normal investment. We're looking from that date. Okay. Then we're getting the information. They're saying 5 other shareholders hold the remaining 60% of the voting rights. That doesn't really tell us much. It's something that we established when they said acquired 40%. And then we knew that obviously the 60% belongs to the other people. Okay, so but let's read further. All the directors are appointed by the shareholders at the annual general meeting by a simple majority vote. Okay, so now I'm starting to think, because as you're reading, you need to be identifying what we call the relevant theory to say which theory is relevant to this particular statement or this particular paragraph that they're mentioning in the question, because at the end of the day, you're going to have to use those standards or those paragraphs to try and answer that question. So now I'm thinking, if it's 10B, paragraph B15, so paragraph B, is this an indication of power? Because now they're saying the appointment of key management personnel who directs the relevant activities. So if you look at this one, it says the directors are appointed by the shareholders at the annual general meeting. So what does this indicate to me? It indicates that the person with the majority or the shareholder with the majority of the voting rights will be able to appoint the majority of the board of directors. And we know that the board of directors are the members of the key management personnel. And what we know is that in terms of this paragraph that I spoke about, which is paragraph B15. So what happens is that you look at, when you are looking at whether someone directs the relevant activities, you look at who directs the relevant activities. It's likely to be the key management personnel, which is the board of directors in this case. So then it says the directors have the ability to direct the relevant activities. So what does this mean? If you were to be asked a question on power or control, already you do not have to discuss this in detail, because the question already gives you that, to say the directors are the ones that direct the relevant activities. And when that happens, we already know that whoever then has power to appoint those directors will be someone that directs the relevant activities of the entity. Okay, so I'm already identifying the relevant theory, and I'm also thinking about the application. Okay, so each director, each ordinary share in New Life entitles the shareholder to 1 vote at the shareholders' meetings. What does that mean? It means that basically the percentage of ordinary shares that you have will also determine the voting rights that you have. So it's the emphasis on the first line that we have there. Okay, so the shareholders agreement may only be amended if the 3/4 of the votes are cast in favor. Okay, so what does this mean? Okay, 3/4, so 3/4, which is 75% of the votes, are required to change whatever arrangement that currently exists. So if Protech actually wants to say, okay, let's change this, maybe let's not base the appointment of directors based on the voting rights, they will need to have the 3/4 of the votes. Is it possible? Is it practical that would happen? No, it would not happen, because they only have 40%. They need to be convincing the other 5 shareholders who own the 60% of the shares. And remember, if they want to change that, it needs to be in favor of Protech. But they're also shareholders and they're interested in this. So it's not in their favor. So it will not be a good practice, or it's not practical for them to be granting Protech that additional sort of 35%, so that they can be able to amend this existing agreement in their favor. Okay, so those are the things that now you are thinking about in terms of, as it looks currently, it doesn't look like these people will actually be able to direct the relevant activities, because they need that 35% at least to make sure that they appoint the majority of the board of directors. Okay, so those are the things that you look at. And then, yes, I was just emphasizing that point to say they do not have the majority of the voting rights to appoint enough directors, and therefore do not direct the relevant activities. Okay, remember, at this stage, we do not know what the question is asking. We are just exploring, and we are being guided by the information that is in front of us. Okay, so one thing that I wanted to mention, as much as we're saying it looks like these people do not direct the relevant activities, you need to be having IFRS 10 paragraph B42 in mind to say it's not only these things that you look at. Are there any other facts and circumstances that I can look at to sort of prove that this person actually do not direct the relevant activities? So you must always go further. So you prove, like we just did now, to say they do not have majority, therefore it doesn't look like they have the majority to direct the relevant activities. But what are also other facts and circumstances that are there in the question? Okay, so we go further. So it says that on the same date, meaning now on 30th of April, New SA issued a written call option to Protech, which would entitle Protech to obtain additional 15%. Okay, so what does that mean? It says now you need to go and look at the potential voting rights. What are the potential voting rights? These are the rights that can be exercisable by Protech, and it says that they can grant them additional 15%. So if they grant them additional 15%, it means they move from 40% to 55%, which is now the majority. And remember, you required the majority to be able to appoint the relevant activities. Okay, and it says to us at any time before the 1st of December 2016. So it means from now until December 2015. Okay, and it says that the call options have no restrictions, financial or any other agreement that will prevent them from exercising those rights. What does this mean? This means that the rights are substantive and therefore they currently exercisable. So if ever, this is how you need to look at this, if ever there is nothing economic, financial or otherwise that prevents the person who holds a potential voting right, or in this case a call option, if there is nothing that stops that person from exercising that right, it is currently exercisable, and therefore we say it's substantive and it should be considered in determination of whether the person has power over the other entity. So you always remember that. And there are so many examples of the barriers or anything that can prevent them. It could be the fact that the call option is not on the money, therefore it does not make business sense for the entity to exercise, Or someone can actually call a meeting to change that arrangement and say, maybe it's no longer based on who has the majority of voting rights, or any other arrangement that can actually prevent them from exercising. But if there is nothing, like in this case, it means it should definitely be considered, because then it is currently exercisable and it's also substantive. Okay, so the call options are currently exercisable at a specified strike price, and should they be exercised, Protech would effectively hold 65. It should have been 55. Sorry about that. 55% shareholding in New SA. Okay, so I did mention that it's just an emphasis. Maybe this question was a little bit too easy, but it's so that you can be able to better understand, because it was just giving you why it is currently exercisable, why it would be considered substantive. In most cases, it would not show, it would not specifically state that, but you will look at the facts around the question and determine that, okay, because clearly there is nothing that is stopping these people from exercising it, then therefore it is substantive. So again, you must always remember only substantive voting rights and not the protective voting rights that are currently exercisable are considered. So we only consider the substantive voting rights that we can currently exercise if we're determining whether one entity has power over the other. Okay, the protective rights, those are the rights that typically protects the interest of the shareholders. Maybe, as an example, a right to the approval of debt or loan covenants, stuff that protects the entity or protects the entity from being exposed to risks, rather than the rights that sorry about that, rather than the rights that relates to the entity maybe being able to generate returns and stuff like that, and making sure that the entity is profitable. So that is substantive versus protective. Okay, so another thing that I wanted to mention here is that Protech now has the majority of the voting rights and can therefore appoint more directors and thus direct the relevant activities. Why am I saying that? It's because of the additional 15% that they just got. Yes, they've not really exercised it, and that's the part that you guys need to understand. You do not have to have exercised them, but you must just be in a position to say at any point from now, I can be able to exercise those options. Okay, so but if the options were saying it's not from now until December 2016, if it says maybe from next year, Jan to December 2016, then it's not currently exercisable. It will only be currently exercisable from next year, Jan. So that's the only time that you start considering whether it is currently exercisable or it's substantive. So that's the part that you need to understand. I must say, as it stands, am I able to wake up tomorrow and actually exercise the options? So that's how you need to look at it. Okay. So on 30 April, Protech has power over USA. That is, it has existing rights, which is the actual and also the potential. Again, please excuse the 65, it's actually the 55, that are currently exercisable. No restriction can be exercised at any time before, no restriction and can be exercised before from now until the 1st of December 2016. Therefore, they can be able to direct those relevant activities. And we did say that if you appoint the directors who direct the relevant activities, you effectively direct the relevant activities. Okay, so that's just now how we unpacked that whole question. So making sure that we pay attention to detail, we read. I normally say you must read word for word, because one word could just be saying something that changes the whole thing. So you must just make sure that you pay attention in terms of your reading. If you read and you're pointing out with your finger, let it be that way so that you don't miss the important information. So you read, and as you read, you identify the relevant theory, and then that theory will guide you in terms of how to respond to the question And I'll get to what I call relevant theory, maybe when we're discussing the solution. Then there's a second part. So when I see Buja Limited, I'm thinking, okay, that's the second investment. So now it justifies why they were saying they've got various investments. So I'm looking at Buja Limited now, and it says on the 1st of June, 2012, okay? When you look at 1st of June, 2012, this is not the current year, because the current year started on 1st of October, 2012. So this is definitely since 1st of June, they acquired 45% interest. So this is the acquisition date. Okay, so remember when I spoke about the acquisition date, that's the date when you start assessing whether someone has control or does not have a control, or they will have a significant influence, or they'll have, or they won't have any of those, but just become a normal investment. Okay, so they're saying they acquired 45% interest in issued ordinary shares of Buja for a consideration of 1652. Okay, so okay, and then they say they obtained control over Buja. So what I wanted, I did that on purpose to have a 45% interest, and I said that they obtained control over Buja because it's another possibility, guys. It will not always be the case that the person that has a majority of the ordinary issued ordinary shares or shareholding will therefore control the investee. No, it does not always work like that. Sometimes you will have control even with less than the majority, because control could also be determined by many other factors, not the ordinary shares or not the voting rights. It could be in terms of the agreement between the shareholders agreement or any other factors, or could be the fact that they're 45%, but also they have the options that are currently exercisable, which give them more than that. But remember, if you have not exercised the option, if you have 45, even if you have got 20% options, if you have not exercised those options, you can have control, but when you are consolidating, you will still consolidate at 45 until such time that you exercise those options, okay? And then it says no goodwill or gain on back-end purchase arose as a result of the acquisition. What does that mean? It means that the net asset value times the percentage holding is equal to the consideration that was transferred. So it means that you paid for what the entity was worth. Basically, that's what it means. So we don't have goodwill, we don't have gain on back-end purchase. And just another part of exam technique here. So when this happens, so you do not have to show me a calculation of either goodwill or gain on back-end purchase. Even if you think that the lecturers made the mistake, no, don't do that, because it means there were no marks that were ever allocated for that, because there is a statement that declares that you will not find a goodwill or a gain on back-end purchase. So those are just some of the exam techniques that you guys need to be aware of. Okay, and then it says all assets and liabilities of Buja were fairly valued on this date. What does that mean? It means there are no IFRS 3 adjustments. What are the IFRS 3 adjustments? IFRS 3 adjustments, it's when they will tell you that the subsidiary has always been valuing this asset maybe at cost method, and therefore this is the carrying amount at the date of acquisition. But the fair value is different to the carrying amount. Remember, in terms of the acquisition method, we must always use the fair value. So if the fair value is less than the carrying amount, then it means it's an adjustment going down. That adjustment, we call it an IFRS 3 adjustment. Okay? So that's what it means when it says they were fairly valued. You will notice that if they were not fairly valued, they will say that they were fairly valued except for maybe plant, land, inventory, debtors. I think in the question that Sajida did, there was debtors that were not fairly valued. So meaning the fair value differed from the carrying amount. So those are the things that you just need to pay attention to. So I think you see that the amount of analysis that went into just seeing the line and then thinking about something. You just don't see a line and skip like that. If there is a line, ask yourself, why is this line here? Okay, what does it mean? So that even if you decide to ignore it and don't do anything about it, but you know the reason why you did that, don't just skip and say, no, I don't know about this, and then you move, because it might just change the entire answer, and then that's where you lose marks. Okay. So this is now the important part, which relates to this investment that we spoke about. Okay, and this is now where it talks about, or it addresses the intercompany transactions. Okay, so on the 1st of April 2013, okay, this is now in the current year, Protech purchased an equipment for an amount of 75,000. Okay, so when we say this 1st of April, it's the transaction date. That's when the transaction took place. So if you are someone that uses the timeline, that's when now you go and you draw that line that says, okay, 1st of April, something happened here, because you want to do your apportionment. You want to see if it coincided with the beginning of the year, or it's something that requires that you apportion the amount. So they purchased an equipment for an amount of 75,000. Okay, cool. That is, okay, Protech, I said it's a parent. It's very important to establish that relationship. Remember, it's a parent because they've got that 45% interest, but the question specified to us that they obtained control in terms of IFRS 10. So it's very important, especially when you're not dealing with a discussion question, to pay attention to that wording. If they say they obtained or they acquired certain percentage, just wait until it tells you that therefore they assumed significant influence, or they assumed control in terms of IFRS 10. So that's very important, because it tells you that now you are dealing with a subsidiary. Okay, so unless they want you to discuss whether the control exists or the significant influence exists, okay, then purchase the equipment for an amount of 75,000. Okay. So what are we seeing here? It's an upstream transaction whereby a subsidiary is actually selling to a parent. Okay, what does that mean if the subsidiary is selling to a parent? When the subsidiary is selling to a parent, it means that the analysis of owner's equity is affected. It means the profit that goes into that, it's going to be affected. You need to be adjusting it. What do I mean by that? If it was a parent that was selling to a subsidiary, it means the profit that is affected, it's a profit of a parent. So the profit that you are eliminating, and I think Sajida touched on it when she was addressing the associate, the profit that you are dealing with, it's the profit of the subsidiary if the sub sold. That is very important whenever you are faced with an intercompany transaction or intra-group transaction, especially the one that leads to unrealized profit. You have to ask yourself, who made the profit? And then once you establish that who made the profit, then you will know which one will hit your analysis of equity or which one will not hit your analysis of equity. In this case, because the analysis of equity, it will always be the analysis of equity of the investee, a sub or an associate. You then need to know if the sub or associate bought, then the profit, their profit will be affected, and that's the profit that goes to the analysis of equity. So very, very, very important. Okay, so equipment is treated as inventory for Buja, whilst Protech using the printing equipment as a manufacturing. Sorry about that, the 75,000 I forgot to mention, that's the selling price. We are told that it's being sold at that amount. Okay, and then Buja, it's a subsidiary, they bought it from a subsidiary. Then it says that it's treated as equipment. Sorry, the equipment is treated as inventory in the books of Buja. So Buja deals with this. So they trade on these equipments. Okay, so what do I have to think about? It's a bit of a complication now, because I need to be saying if it becomes inventory in Buja, then I'm dealing with cost of sales. Okay, and then if it's it becomes a PPE in the other end, then it means I'm dealing with an item of PPE on the other side. So I don't have in the books of the person that bought, that purchased, I will not have inventory because they're treating it as a manufacturing equipment. So I'm dealing with the PPE versus on the other side, it's inventory. So it's sales, cost of sales. Okay, so it's very important that I now start thinking, because I know now this is an intra-group transaction. I start to think about the implications of the elimination of unrealized profit. Okay, so when I'm doing the unrealized profit, I need to be thinking about all of those things to say it's a PPE. When it's a PPE, it gets depreciated. Remember, in a case of an inventory, when you eliminate the inventory, it's easy because also on the other person that bought, they're sitting as inventory. Okay. And inventory, we know it's a current asset. It means it gets realized within the next 12 months. So in terms of the realization of inventory, it means whatever profit that I said it was not realized this year and I eliminated, next year opening balance, I just realize that inventory or that profit. But in the case of a PPE, because a PPE, it's a long-term asset, it's a depreciable asset. How it gets realized, it's over time. And that's where we use the depreciation to realize the profit. So it differs, okay? So now, I need to be also asking myself whether this asset, is it being used as a manufacturing asset or not? Sorry about that. Again, I think I just made a mistake in terms of calling it a printing equipment. It's a manufacturing equipment. It must be a manufacturing equipment. A manufacturing equipment, it means it's an asset or an equipment that we use to produce inventory. When we use that to produce inventory, it means that that depreciation is not going to be called depreciation, but it's going to be called cost of sales, because any cost that you incur in producing the inventory, it's going to be called cost of sales. It's going to be transferred to cost of sales. So that's where the complication is. Let me go back and just maybe go slow in terms of explaining that. Let us say that this was just a normal equipment and it was not used in the manufacturing process. It means that the depreciation that you get there, that depreciation will just be called a depreciation expense. But whenever it's a manufacturing equipment and it's used to produce inventory, then the cost of using that manufacturing equipment, it will go to your cost of sales because it's a cost of producing inventory. Okay, so that is why I said there, you've got depreciation versus cost of sales. So that's what you need to be asking yourself. Is it going to be depreciation? Is it going to be cost of sales? Okay, also when it comes to the realization of the intra-group, what am I going to call it? And also the biggest question is in whose books? And we'll see when we look at the journal entries to say what is the effect of this particular item that becomes inventory in one company and becomes PPE in another company. Okay, Protech purchased the equipment from New SA at cost plus 25%. I just wanted to explain this now, because there was a question when Sajida was doing a question there to say, why are they not multiplying it by 40%? Why are they not taking the selling price and multiply it by the 40%? Sorry guys, they're working from home. There's noise that's coming. If you can just bear with me. Okay, let me explain this. When they say cost plus 25%, it means for you to be able to determine what would be the profit. Remember, we are interested in what is unrealized profit. It means that you need to say selling price multiplied by whatever the percentage profit is over 125. The percentage profit was 25. So it would have to be 100 plus that 25. And that's how you calculate your profit. If it says it's cost plus 25%. However, it can be said that it's gross profit margin on selling price. If that's gross profit margin on selling price, it means you take selling price as is and then you multiply by the percentage. In this case, it would have been 25%. But specifically in this question, they told us it's a cost plus 25%. That is why we used the selling price multiplied by 25 over 125. So never get that one confused. So you must always get it right. Cost plus, you need to know that I say selling price multiply by 25, divide by 125. That's how I get my profit. Okay, and how do I get my cost? It's 100. It's the selling price multiplied by 100 over 125. So that's how I get my cost price. Okay, so it says this was the only sales price that occurred between the two parties during the year. Okay, it is just to simplify it for you to say nothing else happened. Okay, Protech depreciates items of PPE over 5 years on a straight line method. Okay, so there we are being told what would be the depreciation method. And remember, I said the only way you realize the value of an asset is through depreciating that particular asset. If it's a depreciable asset like equipment or like any item of PPE. And then it says you must assume the tax rate of 28%. I saw someone was asking about tax. Guys, you should never, ever, ever, ever forget tax unless they specifically mention that ignore tax. But if they did not say ignore tax, you must always consider the effect of taxation. Okay. So in terms of now calculation of what I was talking about, the profit would be the 75,000 times 25 over 125, and then we'll get the profit of 15,000. In terms of now the realization, now that we've gotten the 15,000, we want to see to say how is it being realized. It's going to be realized over 5 years. But remember, this transaction happened on the 1st of April 2013, so we can count April, May, June, July, August, September, sorry about that. So it's 6 months. So that's why the realization will only be for that 6 months. So that's where now the issue of year-end versus the transaction date becomes important. So when you have eliminated, remember the profit, you first eliminate the profit, but then because you understand that this asset is being used, that's where now you start realizing that unrealized profit that you just eliminated. Very, very important. Okay, so now the big one, which is the required. Guys, the required, this is the area where you need to spend most of your time, because you need to understand what are they asking you so that you respond to what they asked. There is nothing as painful as having answered and you've wrote 5 pages and you realize maybe when you move to the next part of the required that you've actually not answered what they wanted, and now you've wasted time. So you need to make sure that you read carefully here, and then when you read, after you've read, then you strategize to say, this is how I'm going to approach this question. This is the question that I'm going to start with, because I believe that I will get more marks on this question, and then it would motivate me to go and do another question. Because if you start with the most difficult, you get discouraged, maybe you start panicking, and then you start losing marks even for the stuff that you would have gotten correct. But that comes with practice. So you just have to make sure that you practice questions, you do questions, and then you will be fine. So it says discuss in terms of IFRS 10 whether a new SA Limited should be consolidated in the consolidated financial statements of Protech Group for the year ended 30 September 2013. Okay, so this we anticipated, but let's talk about the discuss. When they say discuss in terms of there, I'm expecting you to introduce what the issue is, and then you need to identify the relevant theory, okay? And then you need to make the theory applicable to the scenario. And then I said to you earlier, do not discuss in detail what has already been concluded on. I mean, we know what would be the relevant activities, so we don't have to go in a question and try and prove what are the relevant activities. We have already been told these are the relevant activities, so you just need to take that information and just apply it without having to first prove the relevant activities and the direction of the relevant activities. Very, very, very important. And then you conclude. Very important. Guys, you would not have answered the question if you did not conclude. They're asking you here, discuss whether they should be consolidated. So I'm expecting at the end, your response should be, therefore, New SA should be consolidated or should not be consolidated. That's how you answer the question. Okay? So when I say in terms of IFRS 10, then you know that you have to use the IFRS standard as a guide. So it should not be for the first time that you are looking at IFRS 10. So there's already paragraphs that you've highlighted. Remember when we looked at the reading part or the scenario, we're already identifying some of the standards there. To say this is the standard that I'm going to focus on, or the paragraphs in the standard IFRS 10 that I'm going to focus on. So if it says in terms of what standard, then you know that that's your guidance. Okay, and then it says whether it should be consolidated. Can I just spend time here? Because it's something that I also saw at SAICA. Whether it should be consolidated. Guys, they are not asking whether what's this Protech controls New SA. When you conclude by saying whether it controls, therefore it controls New SA, you've not answered the question. It might be one of the steps towards you answering the questions, but the question was not whether it controls or whether it has power or whether it's a subsidiary. It was saying whether it should be consolidated. So you need to pay attention. That's why I said should be consolidated versus if it's a subsidiary versus whether it has control versus whether it has power. So that's what you need to be identifying as you're reading. Okay. So that would be the first requirement, to say you discuss whether it should be consolidated. And I spoke about how you strategize. In your response, you identify the issue, you identify the relevant theory, and I said the relevant theory in this case, it's the theory that can always be supported by what is in your required, so, or what is implied in your required. So anything that you cannot apply based on the information that you have on your required or what is implied in your required, then it's not relevant. So you must just make sure that, okay, I've only identified stuff that I can be able to support, because you will pick up a paragraph that is not applicable here and you just discuss it. But what are you going to support it with? Because there is nothing in the scenario. So use the information that is given in the scenario to then tell you to say, okay, this is the standard that would be applicable. So you bring back that standard and then you apply it. So that's the relevant theory. That's why I don't say identify theory. I say identify relevant theory. So you must always go for what is relevant. Okay. Then the second part, it says provide the pro forma journal entries in respect of intra-group transaction between Protech Limited at Buja that the Protech Group should process for the year ended 30 September 2013. So again there, what I wanted you guys to do in terms of how you approach the journal entries, you only provide the journal entries for pro forma elimination of unrealized entries or unrealized profit, sorry. Only provide the entries for the pro forma elimination of unrealized profit. Okay, that's the question. The question tells you that, and you might be asking yourself, why are you emphasizing something so simple? It's because students go beyond that. Students go beyond that. But if it says for the pro forma elimination entries, you know, and it says that for the intra-group transaction, and we know these are the intra-group transactions. Some might have spoken about the at acquisition elimination entry. You know, that's not how you are supposed to be responding to these questions. Okay, provide the clear description of entries. Which one is a debit, which one is a credit? So it shouldn't just be one line where now you can't see whether it's on the left or it's on the right. Be clear. I must be able to see if it's a debit, if it's a credit, and you should not try maybe to trick the marker by saying, okay, the marker will then decide. No, if it's not clear, we simply don't mark it. So don't put yourself in that position where you will lose marks. So be clear which one is a debit, which one is a credit. Provide clear classification. Is it a P&L? Is it an SFP? Is it an SCE? So I need to see that in brackets. The classification, very important, especially when it contains the elements of OCI and P&L. Some students are not sure whether it's P&L or OCI, so they just leave it like that. And guess what? We're going to leave it like that also when we're marking. So you don't put yourself in that position. Always provide the narrations unless otherwise stated. I don't know how I'll stress this enough. Guys, the narrations, it's normally where you get your presentation marks. So always make sure that you provide your narration unless there is a specific statement that says you should not include your narration. I even say if the question is silent about narrations, just know that for a journal entry to be complete, it must have the narration. So you always provide the narration, and not giving a narration should really be an exception. Always show calculation. Guys, show calculation, and I must have included there that you need to reference those calculations because we need to see where you got that amount, because in most cases you will not get the 100% correct figure, but we need to see the steps where how you arrive at that particular answer or amount. So always show calculation, and you must be clear in your referencing. Okay, and maybe another thing that I did not mention here, and it's applicable to the previous required, the first required, to say, guys, you must make sure that you write neat. Write neat. I'm not saying have a beautiful handwriting, just make sure that you write neat so that we are able to see. And it's even worse now that you are scanning your documents, so it becomes a little bit difficult for the person that's marking to actually award marks if it's not clear. Provide spaces, be neat, and let it be clear for the next person. Show text journals unless otherwise stated. Just show deferred text implications unless it's stated in the question. So in this case, it was not stated. So just make sure that you provide for that. So now let's look at the solution. I'm not going to dwell much because we already identified during our reading time to say this is how, these are the things that you need to identify. So the first part, the subsidiary is an entity that is controlled by another entity known as parent. So that's the identification of the relevant parent of the relevant theory. So when I'm talking about the subsidiary, I'm leading to somewhere because you consolidate a subsidiary. So that's how I'm building my argument. Okay, so very important to note that there are no marks for stating theory, but it's either you write it. If you write it, you must just make sure that you still manage your time. But if you don't want to write it, just make sure that you identify it and then you make it applicable. So when we look at this one, okay, I spoke about relevant theory to say it relates to what is in the required, in the question, and can be supported or can be applied. Okay, again, remember there's no marks for theory. If you look at the second point, it says Protech will need to consolidate new SA if control exists. Okay, so what is that? That's the application, and I said to you that's where now you're identifying the issue. So this is the issue. Should it be consolidated? Should it not be consolidated? Okay, so but what is interesting is that they're introducing something new now, which I need to discuss. If control exists. So the next part is me now identifying the relevant theory that relates to control. It says an investor controls an investee when it is exposed or has rights to variable returns from its involvement with the investee and has the ability to affect those returns through its power over the investee. So that's me identifying the relevant theories. And when that happens, I'm identifying some key principles that I need to prove for me to conclude whether control exists. Okay, one being the power over an investee. Do I have power over investee? Okay, and then do I have access, or am I exposed to the variable returns? Then number 3, I must be able to then use the power that I've proven that I have, and then the variable returns. There must be a link between the variable returns and the power. So those are the 3 things that I need to be working to prove in this question. You see, I'm laying out these expectations. So what is the next? Okay, so now the next move is actually the application of the theory on one of these things, which is the variable return. So New SA has variable returns in the form of dividends due to its 40% shareholding in New SA. So one might ask, but how is this relevant? Because it cannot be, it's not in the scenario, the issue of dividends. But when I spoke about the relevant theory, I said it also talks to what is implied in the scenario. So in the scenario, by having 40% shareholding in a company, it means you are exposed to dividends in that company. So that is the implied part of the dividends. So in this case, New SA has rights to, Protech has rights to variable returns in the form of the dividends. So that's me now applying. Okay, to have power over an investee, an investor must have the existing rights that gives it the current ability to direct the relevant activities. So now I'm moving to the second part now, because I've spoken about the variable returns. I've proven that we are exposed to variable returns. So now I need to move on to the next part, which is the power. Okay, but within power, I need to identify some of the principles that needs to exist for me to then say I have power. So I've identified the relevant theory that talks to power. Okay, so now the next thing would be to try and apply that. Okay, so power arises from rights, and power over an investee can be obtained directly or indirectly and solely from voting rights granted by the equity instruments such as shares, and can be assessed by considering the voting rights from the other shareholders. Okay, so again, because power, within power, there is something more that I can still discuss. So I go further, and it's still the relevant theory within the definition or within the context of power. You see, the first one was the relevant theory was paragraph B9. Now it's paragraph 11. And again, I'm emphasizing the point that for you to identify the relevant theory and not apply it, you're not getting any marks. You only start gaining marks when you apply the theory, but it's still as important to identify the theory, because you will not be able to identify the theory, to apply the theory if you have not identified it. So we're just making it easy for you by actually writing it out, but it just comes from the standard. So now let's look at the application. So now they're making this application. They say Protech only holds 40% of the voting rights and therefore does not have the ability to direct the relevant activities based on the 40%. Okay, so they're making reference to the existing shareholding, and it's important to build your argument in that sense. Don't just jump and say, because I know at the end they ended up having the 55%, therefore they have power. There you lose marks. You lose. It's not about that. It's about showing a lecturer or a marker your thought process to say, I consider that at the current moment, these guys have 40% and therefore they do not have the ability to direct the relevant activities. Why am I saying that? It's because the appointment of and the remuneration of the investor's key management are an indication that the investor can direct the relevant activities. Okay, so that's what I want to see, to say I consider that at the moment these people, they can only appoint 40% of the investors' key management or the board of directors. Then what you also need to check, it's the relevant activity. I mean, it's the relevant theory in terms of B12, which specifies that it is an indication. The person that is able to appoint the key management, it's an indicator that that person might be directing the relevant activities. So then the next part should definitely be an application of that. It says the directors of new SA have the ability to direct the relevant activities of new SA as the directors form part of the key management. So that's the application of the theory that you just identified above. Okay, and then says Protech does not have the majority of the voting rights and therefore would not be able to appoint the majority of the board of directors. Okay, so that part now you've concluded to say, no, I see that they cannot do it. But remember, I told you, you must always look at, are there any other factors? And that's now where we are considering the issue of the shareholders agreement. And number two, we're looking at the options, the call options. So it's still very important to say, okay, guys, even if they wanted to control it with this 40%, that for them to change that agreement, they need to have a 35% more votes to be able to alter the shareholders agreement. In this case, it would not happen because they would need the consent of other shareholders, which is not likely to happen. So that's now you applying that part. Okay, so what I also wanted to highlight there is that the existing voting rights are not the only indicator of the existence of power or direction of the relevant activities. So it's very important to say, when you look at that FS 10 paragraph B12, you don't only, it's not only talking about the appointment of key management, it also have other factors that can be considered in determining whether someone actually control or directs the relevant activities. Okay. I spoke about that, which is the application of power, of the theory on power. And then now that's the part where now we need to look at the other factors. So when you look at that, it was the identification again of the relevant theory. But now what is that relevant theory? It's the theory that talks about the potential voting rights. It says when assessing whether an investor's voting rights are sufficient to give it power over an investee, an investor considered all facts and circumstances, including the potential voting rights. So it's not only potential voting rights that you consider, but they are also considered. So in this case, or the scenario gave us the potential voting rights. So we definitely have to consider them. Am I getting a mark for stating that? No, but it's only when I start applying that information that I start getting marks. Okay, but underneath potential voting rights, there's still another theory that I identify here that talks about it should only be considered if it's substantive. Why am I bringing substantive here? It's because I can support it in the question with the information to say this is substantive because 1 and 2. So, and then it also speak about, for a right to be substantive, the holder must have the practical ability to exercise that right. Okay, so that's still another theory now that's supporting substantive. So another thing that I need to be aware of, which is part of theory, if it's 10 paragraph B23, determining whether the rights are substantive requires the judgment taking into account all facts and circumstances, which includes the barriers that prevent the holder from exercising the right. Okay, so again, it's something that we picked up when we're still reading the question to say, is there anything that stops the people from exercising this right? Okay, it says it must be economic or otherwise. It means literally anything, guys, that can stop these people from exercising this right or making it currently exercisable. that should be considered. So none should exist for them to be able to consider it and determining whether they have power or not. So then we conclude to say the call option is currently exercisable as it grants Protech the right to obtain additional 15% shareholding in USA at any time before 1 December 2016. We saw that in the question to say these people can actually exercise it at any time before such time. Okay. Just the emphasis again, there's nothing preventing Protech from exercising the call option. Here, the call option have no barriers that would prevent Protech from exercising those rights. Therefore, Protech will have, the 55 voting rights, and this gives them the current ability to appoint the majority of the board of directors. See, this is now where we are linking the issue of them not having any barriers, and what is the implication of them not having any barriers is the fact that it needs to be considered, and because it's going to be considered, it will take them to 55, and when it takes them to 55, it gives them the majority to appoint the board of directors. So when they appoint the board of directors, it means that it's the relevant activities that these guys now are directing. So I've proven that these guys have power because of that. So remember, we spoke about power, and then we spoke about the exposure to variable returns. That has been proven. So the only thing that we've not proven, it's the link between the two. Okay, so I can say they have power. So another thing that is very important, and I'll just highlight now, it's the conclusion. So once you've said they first have to be, they first have to have power. Okay, discuss and then tell me that therefore they have power, then you get a mark for that. Okay, if you've identified that there was an issue with the voting rights, with the direction of the relevant activities, well, in this case, the relevant activities we already told. But if you had to first say that these are the relevant activities, you discuss why you say these are the relevant activities, and therefore you prove that these are the relevant activities. Then you move on to say, but who has the power to direct those relevant activities? Or yes, to direct the relevant activity. Then you prove that, okay, Mang has power to direct the relevant activities. Therefore, this entity has power. Remember, you've only just discussed power. You still have to talk about the link between power and the variable returns. So in the next line, it says, therefore, Protech controls New SA as it has power over New SA, which gives it the current ability to affect those returns in respect of the future dividends through its involvement with New SA. So what happened in that particular line, it's two things. It's the conclusion on control. Remember, earlier you identified that there must be control, and then you went on further to say for control to exist, there must be power, there must be exposure to variable return, there must be a link between the power and the variable return. Therefore, there's control. So here they concluded on control, but there's also a part where they're linking power and the variable returns. Okay, now that I've said that there's control, must I end there? No, I can't end there, because the question wasn't asking me whether there was control or no control, but it says that I must say whether it's going to be consolidated. Therefore, I have to conclude on that. Therefore, Protech is required to consolidate New SA as it has control over New SA. That's how now you answer your question. So you've answered what was required. Okay, so this is now the overall conclusion. So I then said they always answer the question, answer what was required. I know that I'm repeating, but you guys have to make sure that you answer what was required so that you get your full marks. And also, it also sets where you need to start with your discussion. For example, we started by mentioning that for a subsidiary, for someone to be a subsidiary, there must be control. So it's because I understand that it's a subsidiary that needs to be consolidated. But if you started the question in mind thinking that you are proving power, you're gonna skip those parts where you're proving that one must be a sub and then there must be control. You'll start the question or your discussion on power, and that's where you're going to conclude again. So it's very important to ask yourself, what are they asking me here? And you respond accordingly. Okay, then let's quickly go through this one, which is the intra-group transaction. Okay, so the intra-group transaction, it was requiring pro forma journal entries for a sub. Okay, so the first journal entry then is to ask yourself, okay, when I sold this, I would have, in the books of the subsidiary, I would have credited revenue and I would have debited cost of sales. Okay, so what you do now, you reverse that. So if you look at the difference between the cost of sales and the sales, it's what would eventually become your profit. Earlier on, because we're using the cost plus markup, I did explain, sorry about that. I did explain that we will have a 25 divided by 125. That would be our profit, and that's what you will credit your equipment with. And then the debit sales and credit cost of sales would be also that 15,000. Okay, it will also be acceptable to use cost of sales. So it would be acceptable to use debit cost of sales of 15,000 and also credit the equipment for 15,000. But I just prefer this one because it makes more sense. It's not the net method. It makes more sense to say what would happen, what would have happened in the books of the person that's selling, and what would have happened in the books of the person that's been receiving. So now that's what we are doing. So when we are crediting equipment, we are realizing that that amount, the additional 15,000 on equipment that's sitting in the books of Protech, it actually relates to an unrealized profit. So we will just bring it back as we're realizing this asset. So that's the first part. The first part is about the elimination. Elimination will always happen. If you had an unrealized profit, meaning one company in the group sold to another at a profit, you first have to eliminate that profit. That's the first thing that you do. And that's journal entry number 1. Look at the narrations. There's narrations, and guys, you can clearly see that there's a debit, there's a credit. So it's what I expect from you as well. Okay, then journal entry number 2. What is journal entry number 2? Journal entry number 2, it's what I said you should never forget. You should never forget that. Okay, so it's the deferred tax. Why are the entries like this? Why is there a reduction in income tax expense? It's because of what is happening. You see that you are reducing your revenue or you are reducing your profit. And therefore, when you reduce your profit, the tax becomes less because the tax is dependent on profit. So it's the tax on profit. Therefore, that's why you will have the debit in terms of the income tax expense. You can also say deferred tax expense. That's also acceptable. So you go debit, deferred tax, and then credit deferred tax expense. That's acceptable. Okay, so again, the narration. Journal entry number 3, which is now what becomes important and interesting. So why are we debiting? Oh, so sorry, why are we crediting the depreciation? We are crediting the depreciation because that is how now we are realizing that unrealized profit. Okay, so again, the question you need to ask yourself, whose depreciation is this? People will think the person that's sitting with an asset, it's Protech. No, this is not the actual depreciation, but it's the realization of profit that we had eliminated earlier on. So that is what is happening there. And again, that 12% is a mistake. There shouldn't be a percentage sign there. So the realization, it's the 15,000, which is the unrealized profit, divided by 5, multiplied by 6/12. 6/12, because that's the the months from the date that this asset was sold to year end. So what is important, guys, is to note that I put depreciation in bracket just as to remind you that this is the cost of sales. Why are we calling it cost of sales? It's because of the manufacturing nature of the equipment that was purchased. So if it's used to produce inventory, which is the manufacturing, therefore it would be cost of sales. But ordinarily, it would be called depreciation expense. But that depreciation expense, it would be in the books of the seller because it's actually the realization of that profit. I know this might be a difficult concept, but you must just get used to that because it gets so interesting when it becomes an ASOC, which Sajida covered earlier. If it's an ASOC and you thinking that that depreciation is for the person that still holds an asset, you would not say share of profit there. You will have that line item as depreciation, and you are wrong. So it's very important to note that whenever there was an intragroup sale of a depreciable asset by an investee to an investor, you need to know that that depreciation subsequently would be the depreciation of the person that sold, which in this case would be an investee. So very, very, very important. That's why I said earlier, ask yourself, who's got the profit in their books? And then it will drive everything that you do. Okay, so in the following year, you will realize the 15,000 divided by 5, but obviously it won't be 6 over 12 because it would then be for the full year. Again, you don't forget the tax. So these are the things that I've been talking about. So part of the year, you apportion, and then the last one, the deferred tax implications. Remember the deferred tax implications. Remember the deferred tax implications. So that's just the principle that you need to master. In a case where this was an ASOC, you would know where you have revenue, cost of sale, you will have share of profit of an associate. Okay, and remember, in the case of an associate, you don't reverse the 100% of the unrealized profit, but only a portion of that ASOC. For example, if this was an ASOC, you will multiply that 15,000 by 25%. Then that would be your share of profit of an ASOC. Remember, you will not see revenue, cost of sale in respect of an ASOC in the consolidated books where there is an ASOC. No, you will not see. But the only line item that you see in respect of the P&L item, it's the share of profit. And in respect of the SFP items, you will see investment in associate. And this is now applicable to investment in joint ventures. I saw a question earlier on if you were asking if all the principles in terms of the measurement of an associate, if they relate, if they are the same as those in a joint venture. Yes, it would be exactly the same. So remember that. And when you look at J2, in a case of an associate, the income tax expense, it would have been the share of profit of an associate. Okay, but because J1 revenue, cost of sale would have been a share of profit of an associate, then J2 also the credit entry would be the share of an associate, is what Sajida was explaining, to say it would be shown net of tax. Okay, so it's very, very important. So general entry 1 and general entry 2 would be combined, but if you are not comfortable with the combination, you can still split them. So you've got J1, which would say debit share of profit, and then it would have your equipment, and then you come to general entry 2, and then you talk about debit deferred tax, and then you credit share of profit. It would still serve the same thing if you are not comfortable. Okay, and then J3, debit accumulated depreciation, credit share of profit, which is now the realization. Last entry, J4, it would be debit share of profit, credit deferred tax. So that's where the importance of understanding who made the profit is demonstrated. So from my side, I think I'm done. Sajida, please help me with the questions.
Okay. Oops. I hear an echo.
I'm trying to see. Okay, let me stop presenting because I can't see how to unmute myself.
Okay. Can everybody hear me? Can you hear me, Malo?
Saj, I can hear you.
Okay, great. So I just wanted to, there were 1 or 2 questions in the group. Okay, I just want to alert the students to please answer the poll in the bottom on the left-hand menu of my UNISA about how useful was this live session. Okay, so please vote on the poll on my UNISA at the bottom. Okay, and as for the questions, Malu, okay, there's a question here. What happens in the 2017 financial year if Protech decided not to exercise the call option? Does Protech account for New SA as an associate from that point?
Okay, can I quickly respond to that? Yes. It would just depend if them not exercising the call options. Is 2016 is 1 December 2016 the last date at which they can respond, or they can go beyond that? If it's the last date that they can be able to exercise, then it would mean that it would not be a subsidiary at that date. So at that date, there would not be a subsidiary, because then they will just be left with the 40. Is it, yeah, the 40% that they had. It's no longer currently exercisable. It stops being currently exercisable. Basically, they will not have the potential voting rights from that date.
Okay, thank you, Malu. There's another question here. This was regarding the intercompany transaction. So the question is this inventory, and why are we calculating depreciation for the 15,000 over the 5 years?
Very interesting. Okay, why are we calculating depreciation when this is inventory? Remember, I said that if it was inventory on both sides, how we will realize this is with the assumption that if I sell you inventory this year, next year that inventory you would have sold it, therefore it has been realized. So I have to reverse that elimination that I did. But in a case of PPE, if I'm selling you an item of inventory and you keep it as PPE, so it means that that item is still sitting in your books, therefore it has not been realized. What does realization mean in this case? It means that it's still sitting in your books. It has not gone to an outside person, or it's not been fully used. Because in a case of PPE, we do not sell PPE on a regular basis, but how we realize the value of a PPE is when we depreciate it. So that depreciation is the one that we're now going to use to realize the inventory. So the difference here is the realization method. So if you keep it as inventory, you're going to realize it after 12 months or when you sell it. But if it's an item of PPE, the person that I'm selling to will still be keeping that asset at year end. So the only way that I can be able to realize this unrealized profit is through depreciating this particular asset. So that's that.
Okay.
And as to why it was called cost of sales, I did explain to say it's going to be cost of sales if it is used in the production of inventory. So it's a cost of producing inventory. Therefore, it would be the cost of sale.
Okay, so I think that answers most of the questions. And would it not only be depreciation if both the buyer and the seller held the assets as PPE? What does the fact that it is a manufacturing asset have to do with the fact that the asset is classified as PPE? Where does cost of sales come in? Okay, so I think we just explained that. I think that's all of the questions.
Yeah, maybe just if I'm going to address the first part of that question, which says if it was PPE on both. If it was PPE on both, the difference is that instead of having sales, cost of sales in the books of the person that sold, it would be other income, or what we call profit on sale of an asset, because we would not process the journal entries as saying debit cost of sales, credit revenue if you are selling, but you would have said credit profit on sale of PPE. So that is the biggest difference that would be there. Otherwise, it would be the same thing.
Okay. Now the others are all general questions, Manu. So I think thank you very much, Malu, and thanks everybody for joining us. Please don't forget to use the poll tool at the bottom of the left-hand menu of my UNISA, you know, just to let us know how helpful was this live session. There is one other aspect that I wanted to highlight if we had time. I thought the session is going to cut off at exactly 2 hours. So I just want to alert you guys, like for instance, if there is like an error in calculating the taxation, but the asset at net asset value at acquisition date of a particular acquisition, if the asset was taken at its fair value, but you know, the accountant at that time, you know, calculated it incorrectly, the taxation, you do not need to reaccount for the fair value of the underlying asset. You just need to basically correct the error in the taxation. Okay, so you would then, if the asset, for instance, was an intangible asset, you would take that asset was then accounted for at 28%, and it should have been at CGT rate, which is 28% at 80%. So you would take the difference between the two taxes, and that would be your adjustment to the net asset value, not the actual fair value of the intangible asset. So also note those little aspects, but they will also come through when doing questions. All right, that's all from us. Malu, is there anything else you wanted to add for the students?
Okay, no, I think what's important, I think it's a general question that's coming now. The nature of these interventions are not such that we will have more of these live sessions. Sometimes it would be the screenshots, not the screenshots, the screencasts, and maybe the videos, or maybe these live sessions. So it would just depend on the need, because these are not your typical study schools or Banksita classes. These are just the interventions based on the need that we assess at the time. Hence, you see, we did not cover everything in TAT 102, but we just identified the specific areas that the students are struggling with, and we provided that intervention, and we felt that it would be achieved through this kind of intervention. But if it's something that we think it would be achieved in another form of intervention, we will do that intervention. So just to answer the question of whether there will be another live session, there might be, there might not be. So it would just be in that format, and this will obviously be uploaded on my UNISA, and we will make an announcement once it's been posted together with the slides. And the errors that maybe we identified in the slides, we will fix them and make sure that we post the correct slide. Otherwise, thank you so much for being part of this lecture, and we hope you benefited.
Thank you, everybody, and thank you, Malu, for joining us. Enjoy the rest of your day.